Hello, everybody, and welcome back to another episode of One Big Stock Market Sundays with me, Jordan, and Will. How are we, lads?
Yeah, all good. How are you, Jay?
Yeah, I'm good, man. I'm good. I don't think George's very happy tonight.
No, yeah, I was going to mention that as well, but yeah, nice 2-0 for City.
I'm fine. I'm fine. Plenty more competitions to go. Plenty more fish in the sea.
So, as always, we're going to start off with the predictions from last week. So, George, if you want to take over, mate.
Yeah, I think it's a nice reflection point. Now, 10 weeks in to sort of look back at what's happened so far. So you've got myself and Jay sat right slap bang in the middle with 50-50 or 5 out of 10 correct so far. John and Will above us on 6 and 7 respectively. And then Stream struggling down on 1, which to be honest, 1 out of 10 is really impressive for something that's a 50-50 each week. So maybe Stream wants to go with what they don't think is going to be this week and see if that actually works. Because yeah, that's actually more impressive of a track record, I think, maybe even than Will's 7 out of 10. So we'll see how things go. And obviously with the stream, what we go through and sort of talk on there, what you want to predict, as I say, maybe it will work to go what you think won't happen and see if that does happen.
I think at this point I might start buying options on whatever the stream suggests. I might start going the opposite way.
Yeah, no. Well, I feel like it's sort of like betting against your own football team, because especially when I go red in the prediction, because now it's been red 4 weeks running as well, which isn't that common. So I sort of went red, like sort of hoping for a point in this, but actually secretly wanting green because of money. So it's sort of like a hedge almost, but unfortunately I was right again. So
I think it's also really interesting that top and bottom have the exact same total prediction. So both Will and Stream have gone green 7 times, red 3 times, except the points difference completely different. It's just really interesting, the fact that they're symmetrical, and then you got top and bottom there.
I never noticed that before, actually. Yeah, because mine's the same as well. I've done the exact same and I'm in the middle. That's pretty crazy.
Yeah, it is.
So a busy week as always. So Will's going to take straight over and do the segment he normally does. So Will, if you want to jump straight in, my mate.
Yeah. Yeah, lots to get into today. There's been a lot of movement in the VIX, gold, Bitcoin, Dixie, the oil. But I just thought I'd bring up the VIX actually, which I haven't done before, just to kind of give you like an idea. So this is the volatility index. This kind of recognizes when like the market's trending downwards, but with volatility trending downwards generally. So we are nowhere near the high of April last year, but we have been pretty high, like quite a lot of volatility. I think a few times we hit 32, I think a couple of weeks ago now. So yeah, a lot of volatility in the general stock market. Gold, another really poor week for gold. So back now under $4,500 an ounce. So again, I think people are becoming a bit more risk off, and I think perhaps strangely enough, in the last few months, gold became risk on, as it trended so high at its peak. I think 5,600-ish. I think that almost became a bit of like a sort of like a copy trade, sort of, where people just piling in anyway, right at the end. So I think naturally, as people have become a bit risk off, gold's trended downwards and people have gone into the dollar. Silver, therefore, of course, is going to be similar, 20% down in the last week. So really exacerbated by the previous moves. Similar to gold, really. It peaked at right at the same time, about $122, but then has come way down. But I think this can definitely go back up again, obviously depending on your time horizon. But yeah, a lot of volatility in silver. So the dollar index has actually weakened sort of over the last 5 days. But obviously, as we know, over the past month of this conflict, so right here is when the conflict kind of began. So as I've been mentioning in the past 3 weeks now, overall the gold strengthening during a sign of weakness is good. So sorry, not gold, the Dixie, sorry. Yeah, sorry, the dollar index. So this is good overall. But yeah, even this has seen some selling in the past week. So things are sort of evening out now around the 99 to 100 range. I'm sure this will just start trending sideways, but it's come a hell of a long way from its 95.5 low. Bitcoin also been struggling, also I think because of a risk off sentiment, also because of the 4-year cycle, also because of the 4-year election cycle. It's doing what it does, and I went into detail about this 2 weeks ago now, about tending to peak around March and then bottoming out in like the autumn time. So that looks like what it's doing. Obviously, we are still in March, so there is room for one more kind of leg up before we probably come down again. Obviously, no one can predict the future. But yeah, definitely been a ton of risk off. And these bigger candles downwards, as you can see here, have totally correlated with when Trump or the Iranians have said or done something. So as things worsen in the Middle East, Bitcoin is getting sold off. So this is the US oil, again, trending really, really high around that $100 a barrel. Brent, which is more relevant for us, is widening its gap now between Brent oil and the West Texas index, I believe it's called, the WTI, which is the US stuff. So because the US produces so much oil and gas of its own, if it wanted to, it could be energy. What's it called? Energy dependent. Is that the word? I think.
Independent.
Yeah. So if it wanted to, it could not export any and just totally rely on its own. So they're not being affected quite as much, but parts of Asia, the UK, the EU are very reliant on energy imports, particularly Brent crude, and that has gone up obviously quite a lot since the start of this war or of this conflict. And then I mentioned this last week as well, the oil volatility index, crude as well. Again, just massively spiking up over the last month. So lots going on again, all because of this region here, which I'm sure we've seen so many times over the last few weeks. Just to look at right now over the weekend. So the US oil, the US crude is up almost 3% since the close on Friday. And then just to give you an idea, the Nasdaq 100 is down 0.84% over the weekend as well. So lots has happened over the past 48 hours. A lot of it from Trump, and then the Iranians have actually come back as well. So Friday in the afternoon, Trump says, I don't want to do a ceasefire with Iran. Sort of less than 2 hours later, the US is considering winding down the war with Iran. So that was a key headline. So that came not long after futures ended, 15 minutes later, after the market closed. And it was a classic Trump comment after the markets close, say something quite market moving. So actually, after hours, SPY and QQQ, they actually went up by about 1%. But as we can see now on Sunday, so Actors reports Trump is planning peace talks. So this seems like a continuation from Friday. But then he put out a Truth Social post effectively saying, if Iran does not open the Strait of Hormuz within 48 hours, the US will obliterate Iran's power plants. So this is a complete escalation, a complete U-turn, sort of like a taco in like a taco in like the wrong way, I guess. I'm sure there is more of a plan, but it does come across quite confusing and not with a clear idea of what they want to achieve. And then Iran came back with quite the predictable, basically saying, if you do obliterate our power plants, we will close the Strait of Hormuz, we will hit vital infrastructure in the Middle East. So that means Saudi, UAE, Iraq, they'll all get hit. And this will now include energy, IT, and water desalination facilities. So this is a key escalation. Basically, if you start to destroy our key stuff, we'll destroy your allies' key stuff, because obviously, like, they can't attack the actual US from geographically where they are. So they're going to go after the allies and just effectively, as I keep saying every week now, go for a scorched earth policy. If you destroy our stuff, we'll destroy other stuff and make the whole thing worse and worse. And I think it's a pure tactic to try and not appear too weak, and to try and reduce the idea of the conflict going on for much longer. They have said that the Strait of Hormuz is open, but I mean, they don't have too much weight right now, the Iranians. However, just like a small threat of sea mines, or possibly like threatening to rocket tankers, that can have a massive effect. So apparently it's open, but I wouldn't put too much emphasis on that. NATO has said that they will try and open the Strait of Hormuz, this key area here. They want the Strait of Hormuz opened, and NATO have said that they will try and do it. But again, it's a lot easier said than done. It's this 21-mile strait. The shipping lanes are 2 miles wide. There's islands. There's various countries. There's Iranian mountains here. There's various things they can do. Like I mentioned, the sea mine threat, the rocket threat. They don't have to do these things, but just by threatening them, like, these aren't warships, these are oil tankers. Like, they can't have a risk of being hit by any kind of bomb. So it's going to be really difficult. Obviously, no one knows really where this is going to go. It's now going into the 4th week of the conflict. Trump did predict around 4 weeks, although I think a lot of people thought that would be 1 to 2 weeks, a quick flash like Trump often does. But it is now going into its 4th week. And just to pick up on one point finally, where the Iranians mentioned that they would go after the water facilities. So Saudi Arabia is actually the world's biggest country which has no rivers. So it's a pretty big country, Saudi Arabia, and it hasn't got a single river. Hasn't got one river. So a lot of these countries in the Gulf, in the Persian Gulf, they rely heavily on turning the salt water into drinking water. And of course it is that in the same area where all the conflict is, in the same area where all the gas fields and the oil fields are, is the same exact area where all the water facilities are. So there's massive amounts of huge, effective, like, sort of factories turning the Persian Gulf water into drinking water. And you can see just how many there are dotted around. And these countries rely heavily on this way to get drinking water. I think there was a report from a few years ago saying that if Saudi's water facilities were heavily struck, they would have to basically take all the people out of the capital city. So 8.5 million people would have to leave if they had no drinking water for 1 week. So that's how serious it is. Like, that's how important these water facilities are. And so far, obviously, they haven't been hit, but the Iranians have threatened to do so. So hopefully, there's no general more mayhem. But with threats from either side, Trump certainly not backing down, being very, very bullish, saying, like, we're going to attack. The Iranians saying the same. Obviously, right now it's a bit of a sticky situation. I'm not sure what you guys think on, like, how long do you think this will go on for?
Everything is just so concentrated around the Persian Gulf, isn't it? Like, where the resources and just where the resources are is where the industry is. Where the industry is where the people live and the demand is, and where the demand is, well, then all the infrastructure needs to be built. So yeah, things just concentrated around there. And Persian Gulf as a whole is just so where pretty much the Middle East is concentrated into. I think the question of how long it goes on for, it's I think America doesn't want it to carry on for much longer at all. But the opposite side is Iran does want to, because Iran's basically success and survival here is to just that, to survive and to stretch things out and to kind of still be a threat for as long as possible. And that's how they end up getting, a resolution that's more favorable to them. And on the US side, what's more favorable to them is a very quick and decisive operation that then means that they're in a more favorable position. So you've got one side that wants it really quick and the other side that wants to stretch out and wants it to last as long as possible. So I think it's really up in the air. The US, obviously, it kind of comes down to they kind of decide how long it goes on for in terms of their resolve to keep chipping away at stuff and keep basically keep being combative and keep taking mitigations and addressing the issues of threats to oil tankers or threats to gas facilities and threats to water facilities, and how they can mitigate that and manage that will then determine how long they can carry on doing what they want to do. But the reason they got into the conflict in the first place, I don't think has reached what they'd want it to. So from their point, I don't think they can stop yet, and they won't stop unless things can't sort of keep being managed, and they can't keep sort of taking some of the things on the chin and helping to mitigate some of the long-term impacts of stuff. But they are piling up. Especially on last week, the sort of progression on the gas industry and the issues there and the long-term impacts there. So I think at the moment, Iran's doing quite well in terms of just keeping a threat, being something that's still significant and relevant. But it's really hard to guess how long it will last for from here. But the US definitely seems to be changing not changing its rhetoric, but some of the sort of ultimatums that we saw over the weekend, I think, is added desperation or added sort of initiative to try and get things resolved sooner rather than later. That definitely won't be what Iran will be looking for.
Yeah, I think there is definitely that desperate sense in Trump's rhetoric for sure. And I haven't really been one to necessarily say this before, but certainly on this conflict, Trump has proven himself that you just can't trust anything he says. Like, he's just said so many different things across the whole spectrum, literally over the weekend, just completely changing tack, like moving billions of pounds in billions of dollars in the market by saying one thing positive, one thing negative, which it always has done. But there does seem to be a particular, almost slight realization that maybe they bit off a little bit more than they can chew with this. Almost treating this like a real estate deal when it's not a real estate deal in New York. Like, this is, really important thing. And because of the bottleneck of the Strait of Hormuz, this has been a geopolitical tension point for decades. So it's not something new. It's not something which can be solved quickly. So yeah, it's a difficult one. I'm not sure whether you got any thoughts, Jay.
Yes. So, I mean, Jordan sort of batted every corner that you needed to do. I agree with everything that Jordan was saying. I think it's quite interesting, the point that you pointed out there, Will, about the water source, really, because they're like the things that you don't think about when this is happening. And like I said, those small details are the ones that make a massive difference, because effectively shutting off their oil, on the contrary of things, is nowhere near as bad as taking out the water, is it? So, yeah. I mean, yeah, it's a damaging thing for the world, but if you look at it at a selfish point of view, if you take the water out for themselves, you're basically, I mean, it's not like it's England where it's normal temperatures all the time. It's critical infrastructure for them, isn't it?
Yeah. Oh, and actually, one thing I didn't mention is that they don't actually have to necessarily directly target these facilities. If they, say, were to rocket or bomb, say, one or two tankers, a massive oil leak, would actually also mean that they can't use the water. In actual fact, causing a massive oil leak may actually cause more water damage, because there'll be effectively the whole Persian Gulf that they couldn't temporarily use for weeks, months while it was cleared up. So there's sort of almost two options to hit that: directly the water facilities, or just cause a massive oil spill, which is obviously crazy. And I do hope that they really don't do that. But if they feel like they're backed into a corner, they're desperate, they're effectively like trying to save their country effectively, you never know what they may or may not do.
Playing devil's advocate on what you've just said as well, Will, because that's a very good point. There is also the side that Iran hits the tanker and blames it on the US in polluting the water, or vice versa. The US does the same thing, because they could easily pass that blame off to the other side as well. Do you know what I mean? It's quite an interesting take, to be honest.
Yeah, I'm not sure how easy they could completely pass it off, but they could more just say, well, almost you force us to do this, and just generally escalate it, because Iran is desperate. So who knows what like a desperate dog will do in a corner. Like, yeah, like they could do anything, try and play some like the information warfare a bit as well.
And the 48-hour warning that Trump gave on Friday, I think it was, that finishes tonight, doesn't it?
So he gave the 48-hour warning today. So we basically got the rest of today, tomorrow, and then I guess sort of a little bit of Tuesday as well. So I think tomorrow is going to be a key day, really. So we see sort of where we go from here effectively.
Yeah, agreed.
So I also wanted to go a bit more again into like the wider macro, because obviously none of us are Middle East experts or war experts, but we do know a bit more about the stock market and macroeconomics, etc. So this week we did have the Fed meeting. It was Jerome Powell's penultimate meeting in charge. Well, hopefully anyway, because he did say that if Kevin Walsh isn't fully put in place, he will stay on as Fed chair until he is. But in theory, it is the penultimate one. So the main message really was inflation isn't coming down as much as we had hoped. But also the classic Jerome Powell, they are going to be going a bit more of a wait and see approach effectively. They're going to see what happens in the Middle East, how long oil stays up for, and whether that means they need to adjust the rates effectively. But one thing he did point out was he wouldn't describe this as stagflation. He thinks that they would both elements would have to be a lot worse. Although people did criticize this and say, well, yeah, it's not quite 1970s extreme inflation, but it does feel like growth is slowing, the labor market's getting worse, and inflation's rising. So maybe it's not out and out stagflation, but it's certainly low-key stagflation, I guess you could say. So Fed rates. Next decision is in May. It's his last one, as I said. Amazingly, all because of oil, all because of the recent the recent bombings and events in the Middle East. This is the current prediction. So this is the CME website, the main website we use for looking ahead at what the Fed rate might be. So it's 93.8% hold, 6.2% hike, which is a complete difference of where we were only 2-3 weeks ago. With most forecasts at the end of the last year were planning 2 to 3 rate cuts, which they were predicting. So we're now, well, let's go ahead. So this again is the same website, but just a different page of it. You get a bit more of a further ahead view. So you can see here that for the next 5 Fed meetings, there's a higher chance of around 6% of a rate hike than a rate cut, which is completely different. The first cut isn't being priced in until autumn next year, which is just a complete change of the landscape. Obviously, higher Fed rate means that people are more likely to buy bonds, and generally, in simple terms, the lower the Fed rate, the better it is for stocks. And they have come down from their peak of around 5.5%, but we kind of hope that they would be nearer 3% by the end of the year. But this is a massive change, effectively, partly caused by inflation. So CPI, PPI, and PCE, they are all hovering at around 2.5 to 3%. Remember, the Fed's target rate is 2%, and that's particularly based on PCE, but the stock market does prefer CPI. But they're all hovering around 2.5, 3%. And remember, these numbers do not include any oil spike. So the oil spike we looked at earlier, this massive hit over the last month or so from where we were, this hasn't been factored in yet whatsoever into the inflation numbers, which are already too high. I will mention this more later, but obviously the Fed has the dual mandate to keep prices around 2% increasing, and generally to keep prices stable, and for maximum employment. So the Fed does have a choice, effectively, to go after this a bit more, to go after inflation a bit more, or to go after the labour market. So we'll have to see where they go. But it'd be hard to ignore inflation if it does start trickling up, way above 3% because of the oil shocks. Again, just to give you a different perspective on the Fed rate. So this is a great website looking at, so here is where we are right now, this line, this vertical line here. And these other lines show where it was 1 month ago and where it was 3 months ago. So as you can see, it looks like we're now pricing in probably one rate cut, whereas only 1 to 3 months ago we were pricing in we're pricing in one rate hike, and only 1 to 3 months ago we're pricing in 2 to 3 rate cuts. So again, a complete change of tact in the US. And in the UK, again, even stronger difference, where again we were predicting around 1 to 2 rate cuts. We're now looking at maybe 2 to 3 rate hikes over the next couple of years, all because of this huge oil shock. Remember, Brent oil, which does affect the UK much more, has gone up even more than crude, which is more relevant to the US. So yeah, massive changes to the Fed policy rate by the looks of it, and the Bank of England rate as well. I think this is important to look at as well. So massive changes over the last few days, really, in the yield. So in the US, the 2-year yield has gone up by about 0.75% over the past little while. So year to date, at the lows here, we were around 3.4%, now 3.9%. So the 2-year Treasury yield, this is kind of the expectations of where the Fed rate will be. So the Fed sets the overnight rate. Then there's like the 3 key ones are the 2-year, the 10-year, and the 30-year. The 10-year is the main one. General loan rates are based off, maybe what like the government borrows, because if people know that they can borrow money from the government for, let's say, 5%, if they want to borrow money from Google or Amazon, they're going to want at least, say, 6% for that risk premium, because money from the government, the US government, is deemed completely safe, because the US government will never not be able to pay its loans. So if you want to borrow money from other people, then you're always going to be paying more than the base rate, because that's what someone can get basically risk-free. And that's the same thing with stocks. If you can get 5-6% from the government risk-free, people are much more likely to want to stick with that than go into risky equities. When the rate is only, say, 2%, then they'd rather be in stocks, because obviously we hope that we can get a lot higher, like a general return, than 2%. The 2-year yield is the one most affected by the Fed rate, because it's the shortest term. And because this is now higher than the Fed rate, which is 3.5 to 3.75, effectively the market is pricing in rate hikes, because a perception is so important. The general perception now is that inflation is going to go up. And the market knows when inflation goes up, the Fed has to raise rates. So everything in the general world of this is always forward-looking. And that's why it's so beneficial to have a really good central bank, a really strong central bank, because it gives the market confidence that if inflation does tick up, or if the stock or if the labor market does really weaken, the Fed will do something about it. But because people want to hold bonds which are higher than inflation, naturally this is going to go up because people are selling them off, knowing that in a few weeks, months, they can buy back and the rate will be higher. The 10-year yield has also gone up from about 4% to about 4.4, and the 30-year is now almost 5% again. So from the low, about 4.6, to now almost 5%. So this will affect mortgages a lot, and this will affect a long-term borrowing. So mortgages will have to be 6-7% if the rate to borrow from the government is 5%, because otherwise the banks would just rather do that. In the UK, the 10-year is now almost 5%, which is extremely high. Only a few weeks ago, it was around 4.25, 4.3. It's now almost 5%. So borrowing in the UK is going to be a lot higher in the coming weeks and months. I think a lot of mortgages, mortgage offers were cancelled over the last week because they're getting ready to basically redo them at a higher rate. Looking at our 30-year, this is just very high, 5.57%. If you look at all time, the last time we were at this level was around, it's not great on this website, but the other website wouldn't work for this. I think it's around 2008. And we all know the GFC in 2008. So yeah, the gilts are very high, borrowing is going up, more of the government spending is going to go onto borrowing. And the Bank of England have obviously got some work to do. And the unemployment rate in the UK is also trickling up now to 5.2%, the highest since 2021. So to bring it back away from the UK, so I think 3-4 weeks ago now, I was talking about the economic cycle, the business cycle, and how we were probably in the late stage expansion phase. You can't really call the peak in the time. It tends to be a hindsight thing. If we were to go into recession, then that's just what happens. That's what the business cycle does. But for the last 2 to 4 years, the Fed has been attempting a soft landing by, as I mentioned before, effectively cutting out phase 3 and 4 and going straight back to 1 by bringing inflation down slowly and carefully by gradually lowering the Fed rate, as they have been doing here since 2003. But as I also mentioned before, those massive shocks, like an energy crisis, does have a profound effect on what can happen. And I think it is concerning. Like, we were in a stable, careful balance of unemployment ticking up, inflation struggling to come near 2%. And that was before this oil shock. And I think, as we know, oil affects everything. It affects basically almost everything in the whole market. When it goes up, inflation goes up. So I personally think, and this is my opinion, that it will be very difficult now to achieve a good soft landing, and we may end up trickling into this phase 3 of some kind. One other chart to mention is this presidential cycle pattern of the stock market. So the stock market generally works in a 4-year cycle based on the presidential cycles. So this looks at the average from all 4-year presidential cycles. So we are obviously around here right now. So we're early on into year 2. Generally, year 2, the midterm year, is always the weakest year in the presidential cycle, and it tends to bottom out. As I mentioned before, September, October tends to be the bottom. This also works out with the Bitcoin cycle as well. And broadly, this is what has happened so far. We had that April dip. Obviously, here it's about March, but like we had the April dip. We peaked into September, October, November. We had the dip into the end of the year. We've rebounded. We've peaked at around early March, and now we appear to be coming down. So what I'm trying to say here is, yes, I know I haven't mentioned great things so far, but I think right now we are broadly following the 4-year stock market cycle anyway, so I'm not too concerned, to be honest.
So just a quick one, Will, just quickly
Sure.
before you move on from this. So two things, because I forgot to mention something. Firstly, if anybody's got any questions, ask them away in the comments and we will either do a bit of a Q&A at the end and go over them. But if there is ones in between, then we will ask it. And Will, there was a question, and I was going to start chucking some of these in from Ollie. And
Sure.
obviously, George, you can comment on this as well. It says, for the UK, does this mean less people will be buying houses if what you're going over is the case? What do you think? What's your answer to that, lads?
Yes, basically. Well, it means that the house prices will probably come down because the cost of borrowing goes up. So, I think that the UK market is very local. It's very, very localized. So you have to think about your area or the area which you care about more rather than just looking at the general UK. But it will mean house prices continue to stabilize or slightly come down, which obviously therefore might make it more affordable, but obviously borrowing is going to go up a lot because, as I mentioned, if we go back to the chart I had up, if the 30-year is at 5.57, that means mortgage rates are going to be, 6.5%. Jordan?
Yeah, when there's a hard sort of change in place, like high interest rates and high borrowing rates, then effectively the affordability for mortgages goes down. More people are excluded from being able to afford mortgage, and therefore that demand side falls down. And the supply side stays the same, demand side falls down. Then with anything, houses or any kind of commodity asset, the price then doesn't have as much upward pressure and it either stabilizes or comes down. And I think that's in line with what is forecast anyway. Before all of this, house prices in the UK were forecast to increase by 2 to 3% annually for the next few years, which is quite a big slowdown from what we've seen over the past recent few years. But for sure, yeah, if interest rates stay as high as this and borrowing costs stay as high as that, then definitely the housing market will suffer in the terms of less demand, and definitely not a house market crash at all, but less growth in house prices, and less mortgages going through. And I'd imagine those who are already on a mortgage and need to sort of, if they have some short-term mortgages coming to an end, would be looking more to get tracker rate mortgages or very short-term fixed rates. You definitely don't, at this moment in time, definitely doesn't feel like you want to tie yourself into a long-term mortgage.
Yeah.
Well, I hope that answered your question, Ollie.
So just to kind of overall conclude, so how did anyone else mention this? And this is just trying to bring something new and not just kind of cover the same content you can get anywhere else. So there's this really famous paper, which is by Ben Bernanke, which was the Fed chair from 2006 to 2014. So this was from 1997, and sort of like the TLDR of this very prestigious long paper is that, so they basically looked at the last 10 oil shocks in the US. So I think from around 1950 onwards to 1997. And they studied effectively what caused the following recession or the overall economic turmoil following those big energy shocks. And what they found is in 8 out of the 10 energy shocks, around 90% of the economic turmoil which happened in that time, they believe was actually caused by monetary policy and not the oil going up itself. So effectively what I'm saying is they attribute 8 out of 10 of the oil shocks, a 90% hit of the turmoil was because of the Fed stabilizing rates or raising rates rather than the oil shock itself. So as I was reading about this this week, I thought, okay, yeah, interesting, but obviously won't happen, it's Jerome Powell, whatever. But then I was like, oh no, actually no, it's going to be Kevin Walsh soon. So I basically try to find out, is Kevin Walsh a believer in this paper? And he hasn't ever said he is. So I'm not saying that, everything's changed, it's all different. I'm not saying that. But Kevin Walsh is a famous hawk, especially throughout 2008. But obviously, we think he's now a dove based on his comments around AI should be disinflationary, and he believes the increase in productivity should reduce inflation, and therefore the Fed can keep cutting and have low rates. And he is also a believer of shrinking the Fed's balance sheet, so less quantitative easing, but also lower rates. So he's not a direct supporter of this Ben Bernanke study, but I did think that is interesting that he may bring some elements to it. And as we know, like as I mentioned earlier, as of right now, there's not going to be any Fed cuts this year. But Kevin Walsh is coming. We've got April, and then that's it for Jerome Powell. From 17th of June, it's Kevin Walsh. In theory, we think he must have said something to Trump about being a dove and, generally cutting rates. Kevin Walsh cannot cut rates on his own. He still needs the vote to be at least 7 to 12. There are at least 3 doves out of the 12, so you think he'd always get at least 3 votes. So there's plus him 4. So he needs to convince 3 other governors to cut. It will be hard. I'm not saying it's the right thing to do, but I'm more just saying because of the changeover of the Fed chair, we can't put as much weighting on this chart as perhaps normally we could in a time where we know it's going to be, completely Jerome Powell, for example. But just to kind of give some caveats to this, during 2008, and that was like the last major, massive oil shock where I think it was like the highest ever, Ben Bernanke was the Fed chair. So this was his paper in 1997. He was Fed chair during 2008, and he didn't follow his own theory, his own paper, his own conclusion, because I think one of the reasons is that it's very hard not to cut rates in that moment. There's like the general emotion, but also the country, the stock market, Wall Street, the whole globe is thinking, well, high oil, higher inflation, the Fed cuts rates, and that perception is so powerful. And when people perceive that there's going to be high inflation, they want higher wages, which pushes prices up, which then is a vicious cycle of a self-fulfilling prophecy of higher inflation. So then you've actually got it anyway. So it's a bit of like a clash of theory and putting it in principle, but it will be interesting to see whether Kevin Walsh does follow even a little bit of this theory, of this general idea, because ultimately the Fed controls interest rates based on various factors, but then there are shocks outside of the control of the bank, like change in oil price going up, but they can't control that. The Fed can't control oil prices, but they control other things. So it's about being aware of what they can control and what they can't control. Just one final point. One thing I found very interesting this week, and I didn't quite realize the total difference of this, is that different major central banks actually have different mandates. So the Fed has its famous dual mandate, as I mentioned earlier, covering inflation and covering the labour market. The Bank of England has a hierarchical mandate. So they effectively, by law, have to stabilise inflation. And then once inflation is at 2%, then they can help the labour market, which is generally critiqued because it means that the Bank of England can basically put us into a recession from keeping high interest rates because of high inflation, but then not cutting because of like the job market. Ben Bernanke actually did work heavily with the Bank of England over the last couple of years to put some changes in place. So the official mandate hasn't changed, but I do suspect that there's a slight softening of it. But I do still expect some rate hikes from the Bank of England. And then I won't go through all of them, but basically these are the major banks, and they all have slightly different mandates. The Reserve Bank of Australia has recently moved in the last couple of years to more of a Fed-style dual mandate. But it is interesting that the ones which focus more on inflation do have more rate hikes priced in now for this year. whereas the Fed and Australia are slightly different, albeit Australia actually raised rates this year. So yeah, I think it is also interesting just to be aware of other major central banks rather than just the Fed and the Bank of England as well.
It's interesting to see the spectrum between them, and almost like the common denominator of inflation and where they prioritise that amongst their general responsibilities, or if it almost is viewed as their sole responsibility, as you say, kind of feel like the one for the Bank of England, which by the graphs they're not doing too well at the moment because our inflation seems to be spiking more than others.
Yeah, but I thought, I just found it so interesting, just sort of thinking more and more about this a perception, because there's a perception that the Bank of England will always try to control inflation. That gives it some strength, but it also works against itself in it completely ignores the labour market, can push us into a recession, but as long as inflation is 2%, it's fine. So it's a bit of both. But if they change that, it would take a while for the city to adjust, because if inflation ticked over, people would start demanding higher wages, higher prices, because they would have less certainty that the Bank of England could control inflation, if you see what I mean. So it's like a catch-22.
No, I agree with both what you touch on there. Like you say, Will, it is a catch-22 if it happens to it. There was another question here as well, Will, that came in from Nico, and I guess, George, you can answer on this as well. Like I say, I'm going to try throwing you these questions as they come in. So, Nico, but do you lot think the war will escalate now due to the ultimatum that Trump has given? So, touching back on what you touched on before we got into the rate hikes, Russ, Will?
I think I'd probably rather not say my direct prediction, really. I don't know. Like I haven't really thought of that, to be honest. Trump's made ultimatums. Trump's word definitely means less, as he's consistently tackled on various things. Do I think there's a chance it does? Yes, for sure. But I don't know, and I'm not really predicting it, but also I'm not really pricing that in as well in my own investing sense as well, if that makes sense.
You got anything to add to that, George?
Yeah, sort of trying to guess the game of chicken, what chicken's going to win, which is kind of what it is. They're jostling for position to have the upper hand, to threaten each other and see who kind of blinks first. I don't think either side wants that to escalate to that point where, like, US threatening to attack Iran's energy infrastructure, because the US is going to know what sort of retaliation that will encourage. And on Iran's side, they don't want to have a point where they sit there and do nothing and keep making threats, which then makes the energy infrastructure get attacked and crippled, because they don't want that either. So it's a game of them kind of who blinks first, and trying to guess that, I think, is the answer to does it escalate from here. No, I don't think any side really wants to. It's just neither side wants to be the one to back down either.
Yeah, I sort of feel like the classic Trump move would be one final large escalation, and then it's done. But because Iran's so predictable, like they're the biggest sponsor of state terrorism in the world. Like, these are dangerous leaders. So I think it's hard to predict, because it's like playing with fire, really.
And I don't think that on the back end of that, like, I don't think it's going to be over overnight. But obviously, we are starting to see signs of the de-escalation attempts, which means that obviously the tide might be changing. That doesn't mean that it will. Like you say, two very provoking countries in their own rights. So it'll definitely be interesting to see what happens. But I guess no one really knows the outcome until it happens.
For sure.
Yeah, for sure.
Is there anything else you was touching on this now, Will? Or is it, do you want to go into the GTC?
Yeah, let's move on, mate.
Okay, George, was you sharing your screen, or are you just touching over it by talking? Or
yeah, I should have my screen up.
Yep, there you go, my mate.
Cool. So yeah, Nvidia's GTC, which is where they bring together loads of different. They basically showcase their latest tech. They bring together developers, engineers, researchers, etc. And this event this year is definitely much more than just them selling their GPUs, which is where it gets its name from. So GTC stands for GPU Technology Conference. So it was born out of a focus around GPUs, but it's definitely moved beyond that now, and their market beyond GPUs. There was a big focus for sure, moving towards owning the entire sort of AI factory space and stack, everything surrounding AI and the rollout of AI and inference and agentic AI. So including the hardware, as we know, NVIDIA is already well known for and represents heavily, but also the software side and the agents that run it, and the things on the robotics and stuff, to bring that into the physical world. So to pick out a few of the sort of highlights, I've got kind of like 4 pools of highlights from the GTC. So for sure, I think the headline announcement was around their Vera Rubin platform, which is their successor to Blackwell. I'm sure most of you have already heard of Blackwell. So Blackwell is kind of the main GPU that we're seeing going into the AI rush, if you like, going into data centers. A lot of the capex that we're seeing is going into buying Blackwell GPUs from Nvidia. It's been their big success story of recent. It's been a big driving factor behind the revenues we've seen, and obviously the big share price increases in recent years. And Rubin is the successor to Blackwell. So it's their latest and greatest sort of GPU product and their wider AI compute stack that then gets scaled, powered into data centers, etc. And then obviously is the engine behind the AI space. So the Rubin Vera is in production now. So not only are they sort of announcing it, launching it, and saying this is coming, but it's actually being produced now. And a lot of partners have already announced in GTC. A lot of big names you'd expect. So we have some of the stocks in the Discord, Nebius as a partner, of course, the likes of AWS and Google Cloud and Azure as partners as well. And those are those that are going to be able to receive and buy those GPUs the earliest. These GPUs in this server stack are designed from the ground up for agentic workflows, so designed specifically for this big scale up that we're seeing. And it's a scalable package. It's made of lots of different sort of chip types that each have their own different functions to obviously create a really efficient, scalable stack as an option to use in your data centers. And I think, so there's some quotes about third-party analysis on these Rubin stacks that they produce 50 times more tokens per watt of power. So if you think of a data center a bit like a factory that intakes electricity almost as like its raw material, and then outputs tokens, AI basically prompts and AI actions, 50 times is a big efficiency leap and a big raise of that capability ceiling. So you can either look at it as these are now much more efficient and cheaper to run because you can produce 50 times more tokens, more AI actions and sort of questions per watt of power that you put into. So the electricity cost per token is dropped down. Also, you're increasing the capacity of these data centers because now with the same amount of power and the same sort of resource going into them, you can produce 50 times more of the output. So it's a big capability increase for this AI space, and of course makes the Vera Rubin platform extremely appealing and extremely attractive to those to purchase it. I think lastly, a big part of it is that it's also 100% liquid cooled. Previous ones had some air cooling, so no longer needing it, being 100% liquid cooled, gets rid of the air cooling costs from data centers. You can then have more space freed up, more cost freed up, and just increases the efficiency even more so. So it's a really attractive new platform that they've launched, especially to those in the space. And there was some confusion around some of the numbers that were quoted, the GTC. I think Jensen did say it kind of weird in the presentation. I've gone back to clarify. So previously they had an expectation of 50 billion across their Blackwell and Vera Rubin chips and platforms.
500 billion, right?
500 billion, yeah. And they've revised it up to 1 trillion in purchase orders through to the end of 2027. And that's not them saying that in 2027 they think they'll generate revenue of 1 trillion from those 2 GPUs and the AI hardware side. It's just from the sort of the life cycle, if you like, of the Blackwell and of the Vera Rubin platforms, that they expect by the end of 2027 it would have pulled in at least $1 trillion in purchase orders, which is still a massive number. It doesn't, because it's not in 1 year, doesn't mean it's not a big number. That's huge. And as I say, it's revised up from 500 billion, which is their forecast only a few months ago. So to double in that short space of time is massive. Then I mentioned at the start about the sort of extra shift towards the software side, not just the hardware, and the move to like the agentic era. I did skip over a thing here, but if you want to take a look through how the numbers break down on the revenue side for the Rubin Vera stuff, the TradingView has a good page. So on the software side, so Nvidia is moving really quickly into the software space. I think ultimately what it does is it helps them to bolster their ecosystem. And ecosystems we've spoken about before are really important, because what it then does is it ensures as much as possible that the customers you already have more reason to stay. And once you capture a customer, they're almost a little bit trapped in your ecosystem, because there's so many biases and so many reasons that are pulling them in and keeping them, versus wanting to look and go to a competitor. So obviously it increases the revenue cycles, partnership renewals, deal renewals, etc., in addition to new customers that you gain. So in the software space, they launched OpenClaw, which is a new open source operating system for AI agents, and NemoClaw, which is the enterprise secured version. They're not just chatbots; they can act as sort of digital employees, if you like. They can use tools, they can execute tasks automatically, things like diary management, for example. And this page here just kind of helps you understand the difference between OpenClaw and NemoClaw. So OpenClaw is the sort of like the framework, what you'd use to set up an agent, tell it how you want it to execute tasks, to connect to other tools, tell it how to operate. And then the NemoClaw is like the security and the control around it. And this here shows the key differences between the two. So OpenClaw is built for experimenting, creating those agents, developing it, and being really flexible, being like an open source, like if you like moldable clay. And NemoClaw is, once you've created that, being able to refine it for production use, increase the control and the reliability of it, and as I say, bring in that security side as well. Why does it matter? Well, software is usually allows for much higher margins than hardware does. Hardware is extremely expensive in the R&D side. Also, with these high-tech chips, with fabricators, with outsourcing a lot of the manufacturing, of course, Nvidia does. That's quite expensive, and although they make a lot of money, their margins aren't as high as something like producing a software and selling a software can be. And again, as I say, it creates that ecosystem. It creates more of that full AI factory in space that you build around your hardware, and creates more reason for customers to stay rather than to leave. On the monetization side, hard word to say for me, I think it's looking about how they're going to monetize this software. If it is something that blows up, how do they choose to monetize it? Is it a per token fee? Is it per agent fee? Is it a subscription based thing? I personally quite like subscription based models, because they're quite easy to predict growth and forecast growth. And as an investor, then it's easier to follow and work out what the forecast is going to look like. But of course, if it's on a massive scale, they may look to do more sort of token related bits and pieces. Then thirdly, there was a big focus for sure on physical AI and robotics, and this may have been one of the sort of key stories that you saw pulled out in other news stories, because it sounds very flashy. It's very cool to see physical robots walking about and what that can mean beyond just an AI agent or AI chatbot. So Nvidia showcased how AI is coming to the real world through the physical robots and automation in the industry. And there are lots of few models which are specifically there for basically to teach and to train a humanoid robot how to see and think and act. Effectively, it's instructions and creating the brain that goes into the robot. I think there was a live demonstration as well during the event of a humanoid robot that's used like a vision, language, and action model. You can see that noted here on this page. That was trained up by Nvidia, using that to follow voice commands. So you can think of it in a factory setting. You've got this humanoid robot that will react and respond to voice commands and then go and complete actions based off of that. It matters massively, because this could vastly increase Nvidia's total addressable market way beyond data centers. Now their revenue is very much concentrated into the data center space and the capex that we're seeing from the hyperscalers, for example. But a section like this allows them to potentially then move into the market of every single factory in the world, every single warehouse in the world, and even every single hospital in the world. The applications and the scalability of a market like that is huge, and could actually exceed vast beyond their GPU hardware side. So it's a very interesting section for them, very early stages, but the total addressable market for Nvidia could be huge there. Look out for partnerships that get announced in that space. Nvidia isn't building the robots themselves right now. They're currently building the brains that goes into those robots. So look for those that are manufacturing them to see, if anything's being adopted from Nvidia's model side and training side as a key indicator there. They're also very quickly on robotaxi. So Nvidia is entering the robotaxi space. So they have created an additional robotaxi ready platform, and they're partnering with, I think, 7 different car manufacturers at the moment that account for about 80 million in vehicle production units per year. You've got the likes of Nissan, Hyundai, BYD, Nissan, Toyota, Mercedes, and a couple others. So lots and lots of, again, a big addressable market there, and effectively that gives the vehicles an ability to choose how to reason, how to follow instructions, how to explain the decisions that they're making, or almost narrate their own moves, bringing the vehicles to life in a way. And as I say, they're creating that platform that then other car makers can adopt and use. And then aside from that, as you can see on this page with Uber, they've announced a partnership with Uber, which will be launching in 2028, again, for autonomous vehicles and robotaxis. So that's their kind of entry into the space, using their technology with Uber's existing market share to tap into that FSD robotaxi section that we're currently seeing with Waymo and Tesla's robotaxi. And then lastly, just on AI inference. So they are leaning more heavily into inference now rather than just sort of the training. So inference is sort of like everything that goes into running AI, and training is what was building AI. And AI as a whole, I think, is shifting more from training and training these language modules and building these language modules to actually the running of them, and the shift and the focus around from that. So they're tapping into the inference more because that's where the sector is kind of growing the most and there's the most potential. So they've integrated Grok 3, which is the LPU, which is a language processing unit, into the new Rubin platform. And you might remember, for those who are closely following the Nvidia space, that they acquired Grok assets recently because they specialize in that inference, in ultra fast inference. So as I say, inference is the running of the AI, and the training is obviously building the AI. And the Grok 3 LPUs are, I think, about 10 times faster for this inference space than GPUs are. So a big leap ahead. As I say, these incorporated into the Rubin platform, so that it's not the GPUs that they're using for that, it's the Grok 3 LPUs, which then makes the stack, again, more competitive and makes the inference side much stronger. It matters a lot because the training demand will eventually fall off, or may eventually fall off, but the inference demand is technically infinite in the AI space. As long as AI is used, then there is a demand for inference, and the more that AI gets adopted and rolled out and applied to different sort of business cases and use cases, then the more that the inference amount is going to increase versus the building side. And by integrating that with that Grok bit, Nvidia is fighting off any startups that are trying to sort of steal the market or be cheap and fast and take in that market share. And again, being that all-encompassing sort of blanket application to the AI factory space and being a one-stop shop for AI. So that's an overview for the most part of GTC. For those who are invested into Nvidia themselves or looking to get invested in Nvidia, definitely take a look through some of the summary pages. I can link some in the server because there's some really good ones with some great summaries about the event as a whole. Those are the 4 sort of main topics that I picked out of there. But it was a 3-4 day event. There was lots more that could be spoken about. Been interested in not spending 2 hours doing it. I think those are the main 4 highlights for those just in the investing space as a whole, to be aware of where Nvidia is moving to as the largest market cap stock that we have, and also where others may potentially move to, and it's a good reflection of the sector as a whole, because I think pretty much all of us in one way or another are exposed to tech and especially AI.
I did find GTC this week quite interesting because everything you've said, Jordan, just then is amazing. There's so much exciting things coming out in terms of like the stock, the company, but also like the globe, like, future of AI, right? But all because of Jensen butchering the 1 trillion comment. It's almost like the whole of GTC, it was almost a little bit bearish because everything was exciting, but there wasn't that much new stuff said. Like that Uber deal has he mentioned like the last 3 or 4 GTCs? Like that's not really new. Like as just one example, and the whole 1 trillion thing. When he first said it, it sounded like 1 trillion in revenue in 2027. Whereas in actual fact, it's 1 trillion revenue over about just over 2 years. But then he clarified it again to say, oh no, it's 1 trillion revenue, yes, over 2 and a bit years, but of Blackwell and Vera Rubin. So it's almost like up and down, up and down. Is it good or is it not? And yeah, it's. I think I mentioned this before, but the numbers are so big now that it's almost like people can't get their head around them, like how big it is. So I kind of think that the 1 trillion number went over people's heads because, well, one, he butchered it, but two, I think it sounds so silly, but I think it's just so big. It's just not being factored into the stock price. It's like it's a bit strange, but that's sort of my take on it.
Yeah, maybe it's almost like a level of, there's such an unrelatable number, because obviously 500 billion is very relatable. But it gets to the point where the numbers are so hard, like you say, to fathom and to almost in a way quantify, despite the fact that they are quantifiable numbers, to really compare it to anything else and to understand the scale does get lost, I think, after a certain point. And yeah, you're right. I think there was definitely like a comms mishandling, which ruined the hype and excitement a little bit, because everyone's like, I don't know whether to be excited or not to be excited, because I don't really understand what is or isn't being told to me right now.
Yeah, and I did get. Obviously, I'm watching from my I'm watching from my study, but I did get a slight sense that it wasn't like the best GTC, even though it has so much exciting stuff. I didn't quite get the same excitement, but I think it doesn't help that they have them every 6 months. It was more like maybe like an annual thing. Every 6 months is quite a lot for new products, new exciting stuff every time. So hopefully the one in September-ish time is going to be a bit better. But I mean, in terms of the stock, of course, I'm really bullish. Like it's a great company, it's a great stock. I'm just more focusing on GTCs itself.
That's some great points, lads. Is there anything else you want to add to that, George?
No, feel free to carry on.
Okay, yourself, Will. You all finished up on that?
Yeah, man. I think we've got a nice segue straight into yours, haven't we? So
yeah, that's it. Right. So it's the first time I've done one of these live, so this will be great. If there is any questions on this or anybody asks anything that they don't understand, George, are you in Nebius as well?
No, I just
No,
try to remember what I did. I recently closed out.
Oh yeah, you did, didn't you? You're in as well, though, aren't you, Will?
Yeah.
Yep. So if anyone has any questions about this, they're more than welcome to pass them off at the end, and we will answer any questions that we can. So first things first, I want to touch on this and why it's important, why networking is very important. So we obviously picked up on this in April, May last year when we was really focused on it. And as you can see, that price was around $20 to $30 back then. As you can see from the views on these videos as well, that most people can't really be bothered to watch through deep dives, but obviously we was touching on this, and there was a few lads, Derpy, Syrup, and a few of the lads in the Discord that were very informative on this. So it's definitely worth watching these videos when people make them, not just myself, other people, because you can find some gems early days. It doesn't mean copy them, but it definitely means you can see a door opening, because this stock is now massively where it is. And if you do want to join that Discord, it is the QR code there or in the description. So first things first, a massive thing that happened this week was the Nebius Meta deal. So it was a 27 billion deal, and there was a 4.3 billion raise as well. So it's 27 billion in contracted demand and 4.3 billion to build the infrastructure. So as you can see, it's Nebius, Meta, and Nvidia. Obviously, Nvidia supplied the kit. Let's cut out some of these. So obviously, some of these images that were on here was literally this bloke was running to buy himself some more Nebius stock. So a lot of buys were coming out, and there was a lot of price targets. There was two more here as well. Raises to 200s, 150s, a lot of buy, a lot of momentum. It felt like we was talking about it, like everybody was talking about it on X, and everybody was now saying they wished it was being at 80 when it was sat around that range for the last month or two. Don't hold me to those exact numbers, but it's been holding around that range for a while. It's butchered my writing. Why has it done that? Anyway, why is the Meta deal so important? Obviously, it's up to 27 billion total contracted value. So it's a 12 billion dedicated capacity with up to 15 billion additional compute demand. What that means is that if obviously if there's 15 billion still after, they will buy up that complete demand if other customers haven't already bought it up. This starts in 2027 and it is powered by Nvidia's Vera Rubin. Sorry for butchering that. This also shows a lot of conviction from Meta. This is a second deal that they've now imported into Nebius. They put a 3 billion, I think it was, or something. I've got it right there somewhere, 3 billion. And then this is another 27 billion contracted in. So that's a lot of money a lot of conviction into their compute. This looks really bad on here compared to how it looked on my thing. It's jumped down, but oh well. So people say, isn't dilution bad for stocks? That's because I was talking to you, George, saying I was going to do a better presentation. You know, that's what's happened. Isn't dilution bad for the stock? Not necessarily. So the raise was initially 3.7 billion. It was upsized because of incredible demand. So it ended up being 4.3 billion that was raised. The interest rates are 1.25% on the 2031 and the 2.63% on the 2033s. Now, obviously, this is where we say favourable rates because the normal rates is 2.28% for people, especially in high capex businesses. And the most common rate is between 4 and 6, what people would get in Nebius' type of structure. So yeah, the conversion price of this is 180 to 183, depending on which year there was. So realistically, if you were getting diluted at those prices, you wouldn't massively be that bothered. Obviously, if you're in now, that's about a 50 to 55% up gain. So to take away from this is really butchered. I should have checked this beforehand. I don't know why it's done this. I pulled it out of Canva. It was fine. The dilution is aligned with success. It only happens if the business performs. And the deals in the last 12 months, that's tens of billions in long-term AI contracts and capital secured over the last 12 months. That's between Microsoft and Meta alone. That's if the deals are fully confirmed, fully completed. So I think that was on that. So Nebius GTC. Nebius will take care of you. Why is this important? Nebius has been at GTC, isn't just marketing. This is where the biggest players in the AI come together. Like Will was saying, and like Jordan was saying, it's one of the biggest events. A lot of people watch this. As you can see, that's Jensen there at the Nebius booth, and a lot of people will obviously be watching out for the companies that are there. Just before the GTC, Nvidia invested 2 billion. Nvidia isn't just a supplier; they're an investor, a partner. They want to see his company do just as well as anything else. It's where they're investing their capital as well. And he also announced the fact that Nebius would be getting the blue fields. What this does is obviously it's early access to newer platforms. It means they're always going to have an edge on top of their competitors. They're always going to be a step ahead. Always have. But something that Nebius always prided themselves on early days as well is that they have found a way with older tech to utilize it for better margins. That was something that they always preached about in the earlier days that I used to put on the videos last year. So that's always been a massive thing. And just a quick one on a clip that I want to share here, which was Jensen real quick. So let me just share this.
Nebius will take care of you.
Did you see those, Steve?
Yeah, Nebius will take care of you.
Actually, that's our new tagline.
Nebius will take care of you.
Nebius will take.
So as you can see, that's Jensen himself. That's a very promising clip for your stock when you see Jensen saying stuff like that, and that they push custom towards Nebius or Nebius, as he says. But that's always very promising for your stock when you see that. What was your take on this, Will, when you started seeing this stuff come out this week?
Yeah, well, just to make sure I say things which you haven't just said, Jay, I think one thing which is really powerful with the Meta deal was that the size of the deal, if the whole thing does get fulfilled, is essentially the same size as their market cap. Like, that's how big this deal is, and that's how relatively small, I guess, in inverted commas, a Nebius is. So it's like a very similar market cap, the actual deal to what the company's worth. Then you remember the 20 billion Microsoft deal. Then you remember they've got so they have stakes or they own was it a ClickHouse, Avride, a 1010, Toloka, I think. So like they have like 5 businesses they own or have stakes in, plus 2 huge deals from Meta and Microsoft, and the market cap is only 30 billion. So if you count all that up, like up and add it up separately, I'm not sure on the exact maths, but it must be somewhere around at least 60 billion, if not 70. If they maximize the deals from both hyperscalers, and if you count all their stakes in these growing businesses. So Nebius is a volatile stock, but I think the future does look bright. Like there's just such great opportunity. They have such a good relationship with Jensen and with the company, that having that priority relationship, basically, I think it is now on like the same level as CoreWeave. Like there was some discussion before that CoreWeave was like the preferred, like the preferred Neo cloud, but Nebius to me feels like it's on that kind of level now. So with that support from the world's biggest company, with all those stakes which they have, and then these 2 massive deals, to me this feels really, really bullish.
Yeah, and I think on the back end of that, one of the things that we liked about Nebius early days when we talked about it and when we got into it is that's their backbone. That's where they've started. They've not converted from Bitcoin miner or any of this type of stuff. It's literally been their go-to infrastructure from day dot from when they did the Nebius side of it. And I know a lot of people compare it to other stocks. We won't talking about those stocks now, but I think what they're doing and how they're executing, I think, has been huge. And it is volatile, definitely. We've seen it swing from 135 back down to, did it touch in the late 70s? I can't remember if it went into the 70s.
Yeah, I think it might even gone to like 72. Maybe.
Yeah, that's it. So I mean, that's a huge swing on the contrary of things. And it can be, again, this is where it can be in control of your emotions. But to be fair, I was quite proud of everybody that we talked to on a day-to-day in the Discord, because I don't think anybody panic sold on that. Everyone sort of just knew where it was going to go, where it was going to be, and sort of left it to ride in the background. And I still think there's going to be a lot of volatility ahead. I think that's the way it is, but the journey it's had over the last year has been phenomenal, because it was at 1920 last April, and going into this April we're sitting around at the moment the 118 mark.
Yeah, and I think just it feels like a nice stock because it's sort of quietly and slowly in the background become like a core one big journey stock, if you know what I mean. Like I think through people like Tom, through Derpy, obviously for yourself, Jay, spoken about it for like for like a year now, and it's sort of like quietly become a stock a lot of people are in. Like there's a lot of discussion about it in the Discord, and I think rightly so. Like it hasn't been a failed stock. It's a fantastic stock with loads more room to grow, really growing like super, super fast. So yeah, and getting these massive deals now. So
one thing I do want to mention that I do like as well is the CEO always undershoots instead of overshoots, which, I mean, in regards to the numbers, they never undershoot. They definitely put them up, but they always say they're trying to attain small growth people like to grow into. He preached about that a lot, and then all of a sudden you'll get a 20+ billion Meta deal out of nowhere, or a big Microsoft deal, which is good. But it's great that we're picking up those hyperscalers and picking up those good wins. And like I say, it's going to be a company that I hold for a long time. I really like it. I don't even think when it gets to the PTs that I set in my videos and stuff that I've done that I'll sell those at those, because I just think it's endless with it really for the next couple of years. It's here to stay, isn't it? So
it definitely does feel interesting that some of the Wall Street analysts are giving really high price targets, like 150, 200, 212. I think maybe even one might be like 242.
Yeah,
like,
I think I've seen a high one. Yeah,
those are really quite high price targets, which not that we should be basing our conviction off Wall Street analysts, but it does definitely give you a bit of a slight reassurance that it's not just us seeing this.
Yeah, and normally it's the other way around, isn't it? You're seeing the analysts try and pull these stocks down to get themselves in. Obviously, you are right, though. There's some high targets. They've got a high capex that they've got to make sure that they keep executing and keep doing. Jordan, is this something that you see yourself ever getting back into, or is this something that you sort of checked off, made your money, and you're onto different things now?
Yeah, there'd have to be. I like the stock, and if there was a big drawdown, then I would. The reason I sold was more just general portfolio management and sort of housekeeping, where I wanted to reduce my data center exposure a little bit, because I was quite heavy into data center side of things, and obviously I've got a big holding in Google, which is also like an all-encompassing AI and data center sort of capture, and I wanted to reduce it, and yeah, exactly that. I'd made some gains on it, was happy to realize those profits, and close out the position at a good standpoint. I think it was like 113 or so that I closed out on. But yeah, if the future there's a big drawdown and it wasn't fundamentally because of much to do with the stock itself, then the stock is still an appealing one now. And if I didn't have other data center exposure, then I'd still be in it. So assuming then it would still be attractive, just at a cheap price, then for sure I'd get back into it. And as I say, long term, I think it will still do well. And this isn't me selling because I think it's at the top at all. It's just because, as I say, I wanted to manage how much I was sort of dependent on data centers doing well.
I think Nebius, in terms of like the stock, it is a tempting one to sell, because I'm not saying that this is right or wrong, but I can see it definitely plays into the mindset of, oh, well, if I sell now, maybe I can buy in lower, because just that's how volatile it's been. Like, it really has been all over the place, highs of low 140s, then down to low 70s, and all the way in between. So I'm not advocating for this. I'm not personally doing this, but with some TA, I think it could certainly be tempting to sell and try and rebuy back in. But that's not a reflection of my view on like the company as a whole.
Yeah, and I think like Jordan just said, I think myself that was the exposure to it, and that's why I started following it. It's not like I hold a lot of data centers. I have got another riskier one. Obviously, we've got Hive in there as well. But I think when you're looking for a solid data center play, like Jordan said, he's got his Google over that way. I just think Nebius that's my anchor in that pace. That old in a couple of years, obviously, it's going to be a bit more, hopefully, a lot more less volatile, and it's more of a steadier. But we're in early years of it. Like I say, to jump from 20 to over 100 in 12 months, I think that's great for a stock's growth.
Yeah.
So obviously on to the next segment of the question of the week. Obviously last week, I'm not going to say this guy's name because I will absolutely butcher it. I'm just posting it there. But Jordan, you can go first on this because we're going to go backwards on this one. So if you started your journey and went back to 18, what would you do and change?
Good question. Assuming I at that point knew about investing but hadn't done it yet, I'd get straight into it. Like, I wish I started at 18. I didn't start till I was past 20. So anyone who is starting at 18, like, pat yourself on the back because that's really good. I think when you're 18, you've got to be really honest with yourself. And if you don't know a lot, which is probably the most likely situation, which is normal and fine, like it's very unlikely that you're going to know a lot. Just be honest with yourself about that and accept that, and act accordingly. So, go for safer bets. At 18, you might feel a little bit more reckless, a little bit more high risk. But I think when you do know very little, you should go safer, and you should be, when you're first starting out, almost all in safe bets, almost all in funds, for instance, at least whilst you're learning, and whilst you learn more and whilst you feel more comfortable and you understand the market more, then obviously you can start to explore individual stock picks, etc. But I think when you're first starting out, just play it safe. The main thing is that you're started. You've got that ball rolling. You've got that compounding snowball that's going down the hill rolling. To just make the most of that time that is starting so early. And then, just try and absorb as much as possible. Be a sponge. Go surround yourself with people who maybe know a lot more than you, have been doing it for a long time. Go to sites and research points, and just try and absorb as much as you can early on. Work out what does and doesn't work for you. Just be a sponge and play it safe to begin with.
Yeah, I think absolutely. Like, I didn't start properly investing until I was 29. So yeah, absolutely. I think the best time to start ever is on your 18th birthday. And then if you're older than that, the best time to start is today. So absolutely just start investing, get that compounding going, take time to learn, take time to do it safely and wisely. Like, you got literally many decades ahead, especially if you are 18. And then look at funds like VWRP, ACWI. Just think of a global solid fund. Just start that compounding, start the process. Even if you're putting in £10 a week, £20 a month, whatever it is, if you if you use a compound calculator and you put, I don't know, 18, let's say to 68, 50 years, and you slowly build up, that compounding will start trickling up. So the best thing you can do at 18 is to start.
Yeah, I think that's a great answer. And I think that'd be a little bit what I was going to touch on myself. The advice I would give back to myself if I was 18 would be exactly that. Start. I'm 29 now. I started properly 2 years ago. I knew about it before that, but started properly 2 years ago. And I think the best thing to do is just start. It makes a difference. It doesn't matter whether you've got £10 spare a week, whether it's £20, or even if you're more lucky and you're living at home still. I think that's where you should be capitalising more on it. I would say don't chase risk, chase safety. So like you say, I think funds and stuff are important. Understand pensions, understand how they invest in your money, and learning and doing it in a safer environment as well while you're learning. But then of course, once you have learned and you're more controlled and you understand what you're doing, I would then say the fact that then you can take more risk. You are younger, because you can put yourself into more exposure. And that would be my advice to myself. I'd say starting is more important. It's okay to take risks, but take calculated risks and make sure that you understand what you're doing before doing that. Now, I'm going to touch on a few of these comments because they're actually quite interesting. So I'm going to touch on some of these. So it is important before we move on. So Nicole said she only started 18 months ago, and I believe she's just said further down that she is now 48 years old. But again, it's about starting. Doesn't matter your age, it's about starting. Paul said nothing. I had a bloody good time. Paul also said we didn't have phones back then, so thank God. Ben said he started 2 months ago. He's 23. I think that's amazing.
Yeah, fair play, man.
Yeah, fair play. That's a great age to be starting. He also said he's trying to get his mom involved, who she's 48, nearly 48 as well. I think that's great. I think I tried to do the same with some of my siblings. It didn't stick. It doesn't stick for some people. It is what it is. And then Paul just said, he said start today. That's great advice. And I think someone's just also said you're only 29. Must because I look about 40. But no, I think that's a great question. I think obviously some people have thought back to that and think about that. And like I say, like any age is a good age to start, because most people, I think the interest calculator is a great thing to do, because when you I think that's a great thing, Will, because when you sit down and work out what you can do and put those percentages in and work on them, you actually can be quite amazed what you can do in 20, 30 years, especially with compounding.
Yeah.
So that was a great question of the week. So I'm going to say his name because I'll absolutely butcher it, but thank you very much. And if anybody else has got any questions that they want to ask on the stream, that's totally fine. Or you want to ask a question where we do a segment on it, don't forget to pop it in the comments or put it in the chat and we'll do it. So we're going to start looking at the week ahead now. So we've got quite a busy week ahead. There's a lot going on. I'm going to just pull up Discord real quick. I have to do it on a window like this. That's fine. So we've got a busy week ahead. So not much going on. Oh, where's he gone? There we go. Not much going in the case of earnings. So nothing too exciting. So I'm going to just touch on exactly what everybody's watching this week. So Jordan and Will, are you both investing in Ondas?
I am, yeah.
No, I'm not.
No, okay. So Ondas is a big stock in the Discord. It's been a big stock I've followed. If you are a follower of the channel, then you would see that I interviewed the CEO and a lot of their staff that's on their board, which was a fantastic opportunity. Everyone's tagging like on to that. So Ondas is a great company. We've been following this for well, I think just over a year. I could just be wrong, maybe just under. It's been around that time. It was 79 cents a share, then 179 cents a share, and now it's had a great run. So we're looking for big things into earnings. I've just done a Q4 preview. So if anyone hasn't seen that, go and check that, go and look it up. Paul. So yeah, it's great stock. Definitely one that we're going to be watching out for this week. Jordan, what are you watching out for Ondas? What's your thoughts on what's going on?
Probably what's been spoken about in the server quite a lot in terms of the guidance to see how much they are or aren't going to try to sandbag themselves. To see how quickly some of the guidance revisions come through. And even if it's, a 10 million revision or increase, I know some of the numbers and some of the stocks we look at, 10 million feels like quite a small number, but if you consider 10 million of the overall sort of 180, that's a big percentage increase, like as a massive percentage increase. So, when you're working with smaller numbers, if you can call 180 million a small number, when you work with smaller numbers, I think it's always handy to sometimes practice converting them into percentages, because percentages are always relative to each other. And that will really help you understand some of the numbers more and make sure you don't overlook numbers, because I think it's easy to, but it shouldn't be something like a 10 million revision on 180 million previous forecast is a massive thing, and definitely not something to be looked over.
Yeah, I was a little bit skeptical about the EPS, but after seeing that Warren cash, it's just completely gone out of my head, cash positive of the other day, the accounting hour thing that they did, that's filling me with a little bit more optimism towards the EPS number, which I'm looking forward to. So that'll be interesting. Definitely want to see. I think we all know it's coming. Be very surprised if it doesn't. A guidance up hike as well. I'm about to flex on people now, by the way. I was just looking at the text messages with Eric to see when it is, but we are booked in to have another interview on the 29th of March. So I think that's next Sunday or Saturday, next Sunday. So be looking out for that. They're all giving me shit in the chat because I've got a jacket by Ondas. But yeah, no, I think it's a great stock. I think I'm looking forward to it, and I'm looking forward to listening to the call and what Eric talks about for the future going forward. So, like I say, on to what we've got for the next market outlook as well. So we've got to find a way of making this a little bit bigger. But market tracks Trump's 48-hour warning to Iran. March S&P Global Services PMI data on Tuesday. US crude oil inventory data on Wednesday. Initial jobless claim data on Thursday. March MI consumer sentiment data on Friday. And the MI inflation expectation data on Friday. What's your thoughts on this, Jordan? What you're looking out for this week? What's on your mind?
Definitely 1 and 3, the main ones for me. Of course, any more developments in the Middle East, I mean, that's the main thing that's pulling and pushing the markets at the moment, both short term and with immediate price action, but also long term for what our outlooks look like and what we can expect with inflation and rates and that sort of thing, because it's definitely feeding into the long term macro stuff more and more, and the long-term forecast more and more. So that's the most important thing for me watching over for the first couple of days of next week, to see sort of how that progresses, if it progresses positively, if it progresses negatively, and then obviously making some adjustments of my own expectations and ours as a community as well. And then just the third point about the US oil inventory is just combining that into obviously any more progressions, any more stagnations that go into that, and then combining the inventory data with that again to format into that outlook, and how to sort of basically feel for the short term, but as I say, not only short term, also the long term.
Yeah, and is there anything that you want to touch on that as well, Will?
Yeah, just sort of, I think particularly because it's more fresh in my mind based on what I've been reading this week to prepare for the stream. I am going to be definitely looking out for the number 6, the general inflation expectation data, because that's going to be really a key time to have the expectation data, because with all the oil stuff, it's going to be really critical to feel where like the sentiment is. So you'd obviously think that the sentiment is that inflation is going to be up, but how much up? Because if the expectations are going to be inflation is going to really, really creep up, well, that means that kind of affects how the Fed operates, because we don't want to get into like a self-fulfilling prophecy of or like actual inflation itself. So yeah, I think that so the main ones are the futures tonight, tomorrow, how things go in the Middle East, obviously like the jobless claims on Thursday, but also I think on Friday for me, I will be interested to see what the inflation expectations data is as well.
Yeah, no, that's, like I say, it's quite a busier week, but I think most of the stuff that was going to be, like you said, the expectations and stuff is definitely something to keep an eye on. But I think most people are going to be watching what's going on in the news like they have been. I think that's where most people's minds are quite set at the moment. Rightio, so closing out segment. So we have got one question here from Paul that he asked, and he put, okay, if this war and oil crisis gets worse, will any of you be adding to or buying any oil or LNG stocks? I'll go first and we'll work it down to you, Will and George. Me personally, no, I won't be buying them now. I feel like if you wanted to get entry points, it's a little bit how the gold and silver rally went on. Each to their own on their opinions. Obviously, this is my opinion on it. You don't chase rallies. That's how you get burnt and get caught bag holding. So if something's normally already shot up to the stars, you don't normally buy at the very top. It's not smart or clever to be doing that. Like I said to you in the chat though, Paul, VG, people were talking about this stock for months in the Discord. It was like 6. I think it's like 16 now. So obviously, like I say, it's about understanding markets before they happen, but some stuff just can't be predicted.
Yeah, I mean, I think Jay, you basically nailed it. But just at one tiny point, as you kind of as you kind of implied, like the time to buy was weeks or at least months ago. Sorry, it was weeks and months ago. Really, like I think it's too late now. Like I want to make money, but I don't want to chase and risk money on stuff like that. So it would have been good to be in them, but I think it's too late now. So definitely not for me.
Yeah, it'd be a bit of a pivotal strategy for me to then start buying into them because I wasn't already looking at them beforehand. I'd be using any cash to buy dips on stocks I already liked beforehand and now are even cheaper and I still like now, rather than buying into oil stocks to try and sort of jumping on the rally and invest in stuff that I wasn't previously really looking at. I think that's kind of a little bit of the emotional side pulling into it, even if it's not necessarily FOMO. And it's thinking, oh, there's this opportunity that's come up that I might be able to capitalize on. It's still drifting off from what you'd otherwise be looking at had this not happened. So I think it's good to still keep yourself grounded into what you've always been doing or you've been doing recently and not stray too far from it.
And just to touch in the last little bit of this, all three of us, I'm thinking you, Jordan, as well, I'm assuming all three of us was buying this before it happened because we buy funds quite regularly. So because we're in S&P 500s and all worlds and everything, we've already got our exposure to this well before it happened. I guess is a way of looking at it as well, isn't it?
Yeah,
true.
You have to disagree about buying all those time highs when it's marking. So like Paul said there, but I have to disagree because buying at all-time highs is when it's making big progress. The price can't go higher unless it makes new all-time highs. But like, yeah, I agree with what I know what you're trying to say, Paul. But like we just said on it, you get chasing. Sometimes you can get burnt. So you could buy gas prices or oil on Monday, and the war could be over Tuesday, and all of a sudden there's an influx of supply, and you would be caught holding that top. There is obviously opportunities there to pick up when they are there to pick up, but you got to get in them earlier days. Yeah, Paul's just said the same thing there. Look, have you ever seen loads of chats on 212 people getting burnt big time? It happens, man. It happens. So on to the last bit. So we're going back into our predictions. So Will, because you are top, we'll work our way down. Where you at, Will?
Yeah, that's a good one. I thought I'd just quickly have a look to see when was the last time we had 5 red weeks in a row? Is that even? Is it even a thing? So I'm going back. I'm in 2022. 1, 2. Oh yeah, here. Right.
Yeah,
Actually, the exact same time 4 years ago, we had 1, 2, 3, 4, 5, 6, 7 weeks in a row from literally exactly the same time, March to May. We had 7 red weeks in 2022. Do I think we're going to go red again? I think we do. I'm going for red again. It's not like me. I like to be quite positive and bullish and green and whatever you want us to call it. No, but I think I'm going to go for a 5th red week, unfortunately.
No, fair enough. What did John go for? He did put it in, didn't he?
He went red.
John went red as well. Okay, so firstly, I'm going to be the one that throws the tide then. So I'm going to go green. I think there's a case that we see de-escalation a little bit this week. Again, I could be wrong, but I think that we're heading into that type of territory. So yeah, I think green. I think because we're already finished and we've got all this opening over the weekend as well. So we're already going to open probably a little bit more volatile on the futures, etc., because that's how the market reacts normally. So we will see in a couple of hours. But yeah, I'm going to go green. I think we're going to finish the week on green.
I will go for the opposite of whatever the stream says. I think similar reason to last week, where as much as there's been a few red weeks in a row, the early red weeks weren't really red. But if we did have a color scale, they were a lighter red, and last week was darker for sure, but the ones before it quite light. So I still think there's room for red, and I will go red.
Nice. So we've got 3 reds, 1 green so far. Sorry to break it to you boys, but we had 53 votes on the stream, and they have chose. It was very close, but they have chose red as well. So
Damn.
it was nice getting a point for that week.
Yeah, congrats on the point.
So it's okay. So there's another question here. So it's worthy of a question. I don't know if you're going to have an answer to this straight away, but I think I have. So it might be good. So obviously, Charles asked, if the markets did see a meaningful drawdown this week, what is one stock on each of your watch lists you would like to add to or start a position if there was any? Have you boys got one of those to mind?
So I probably will do in about 10 seconds. So yeah, you just come back to me.
Okay, you go first, Andrew.
Yeah, I'll jump in because I was speaking in Discord a little bit. When I'm sort of looking towards April ISA reset and, having some more contributions and what stock that cash might be deployed into, the kind of main one I'm looking at the moment is SoFi. So SoFi does continue to draw down. Then I looked at it. It became a bit of a legacy position for me where I've been in it for a while. I think my average is about 12. I sold a lot of it out above 20 and then kind of left a lot to run as like a long-term legacy position. And it wasn't really then a focus for me in terms of adding more to it or growing it again. It was just going to be left to do its thing and compound and having that full confidence in SoFi. But the drawdown, which I think is like 50% almost now since its all-time highs, has changed that a little bit, and it's looking more appealing and attractive in a stock that I previously wasn't really looking to add to, where the fundamentals have continued to improve and the stock's just as attractive as it ever has been whilst being cheaper. I've started to change that. So I think that would be my pick if there was even more of a drawdown. As I say, already now I'm looking at that for April.
I definitely want to pick up some more Robinhood if that does hit 69
You're
again.
both bad. That's the 2 stocks I was just about to say.
Yes, I'm definitely looking at Hood if it touches 69, although you've got to be quick because it seems to wick down to 69 and then come right back up, because basically everyone buys in the 60s. So I probably would add to Hood. I am looking again at a Gemini space station. It's a small cap, a crypto play. I sold my position a couple of weeks ago, made a little bit of profit. They went higher, but then they come right back down to like the all-time lows. So that's quite tempting. That's the ticker GEMI. So I need to have to think about that one. But also, honestly, in times like this, I like to add to my funds as well. Like if everything's going down, I want to add to my core 2 main fund portfolios. So I will be buying in general. But actually, I could say this now. I was maybe saving it for like maybe next week, but I think this sort of ties in. I have actually got like a major personal announcement to make, if that's okay.
Yeah, go on.
I officially changed my mind about something. So I've always harped on famously for cash is trash, inflation's the devil, why do you hold cash? It's crazy. Over the last 15, 16 months, as I've been learning more, I definitely now think it's worth having some cash. But I would caveat and say the higher proportion of one's portfolio into funds, the less cash one needs to have sitting on the sidelines. So the more individual stocks I now have as a percentage, the more I think, actually, yeah, I wouldn't mind some cash. So yeah, there we go. I've come clean. I like cash. I definitely have a smaller cash percentage than you two. So I'm still talking cash like 1-2%. So that's what. So when I mean cash, I literally just mean 1-2%. I don't mean 5. I don't mean 10. I don't mean 20. I don't mean 40k. But yeah, cash maybe isn't as bad as I thought. All right.
So does that mean you're going to change your Discord profile? Just because I'm looking at it now, and it still says the same. I'm looking at it.
Yeah, I might have to actually.
He said 40k, by the way, Joel. He's hinting at me because that's what I was sitting on for ages. The two
the
stocks.
Smurf is going to take a while to go.
To be fair, the 40 went down to like 15. It was back up to like 20, and then I bought some. Well, the two stocks I bought some of this week was the two stocks you guys both mentioned, which was ironic. I bought a little SoFi when it dropped down. I think the prices is and obviously someone commented, and the prices are because rate cuts have been took out of the equation. There was the report and stuff that came out. There's a bit of going on there, so obviously that happened. But I think Hood is just such a good price. I think if the cycle continues that we talk about every week, I think it definitely going to go lower. But I think an average of around the price it's at now is great to have. Because on the flip side, you both said that, I would have to say that if the drawback continued into the late 10s, late 9s and early 8s, I would pick up Ondas more again. I've obviously the problem is with such a high beta stock that you can swing trade it and make easy money. I think last week over a couple of days, got to have made a few £1,000 off just swing trading whilst being at work. So there's definitely opportunities to take it into those accounts. But yes, SoFi and Hood are definitely two positions, and I've been buying Hood a lot, so I do enjoy those stocks. Here's another. We've opened a can of worms here, guys. We'll answer one or two more, and then we'll do there. So Paul said, how much time do you guys scan the market? Now, this is a little bit different for us because of the community we've got makes it much easier for us. So I'm going to answer first on this and then leave you two with the struggle answers. So with us, we've got obviously the Discord, and there's 500 of us in there. And the beautiful thing about that is that people bring, for instance, Cho, I'm going to give you a plug if you want to put your thing into the description, you can, for your X account. He's been preaching about Takeoff for a long time. I haven't invested myself. I don't know if you lads have yet. I do like the look of it, but there's certain things I don't. But people bring a lot of stocks in. SoFi was brought in, Nebius was brought in, Ondas was brought in, Hood was brought in, HIMS was brought in when it was at its lowest. The list just goes on. And the thing is, that's where it comes down to. It makes many hands make light work, because sometimes we just go crazy and then we all start researching together, and something that would take you probably 10, 15, 20 hours can be done in a few hours. It's important, obviously, you go away and do your own thing as well, but we do work quite well as a team. But I do spend a lot of time when I'm looking for stocks and stuff, but I don't really know if there's an answer to that. What do you boys think?
I'm not 100% sure what scan the market means. So
I think looking for stocks.
Okay, in terms of looking for new stocks, not often, to be honest. I've got quite a few stocks. I've got my ETFs. I'm happy with what they're doing. And if you more mean like, am I watching the market? Like, am I watching tickers? Again, I try not to, because I don't think there's any benefit of just staring at numbers all day when you can't control them. Like, especially in like a downturn, why am I just watching Hood go from 140 to 69? Like, how's that benefit me? But so the best way, if you meant more of that side, is kind of like have alerts set on TradingView or on Trading 212 when certain prices are hit or when certain percentages are hit for actual, like, so in terms of like your actual portfolio. But in terms of new stocks, not often. But in terms of like scanning the market for like macro news, headlines, all of that geopolitical stuff, yeah, like quite a lot, because I just really love that stuff.
I took the question is kind of like how much time do you spend following sort of market news and stocks and stuff, and I wouldn't know the actual sort of quantifiable time unless there was a way to set up sort of screen time tracking on my computer and my phone. Like, I'll flick through maybe every other day charts on all the stocks that I'm either in or watching, or ones that are moving. Market data, like it's daily. And then obviously plenty of time each day on the Discord as well. So yeah, I don't know what it adds up to, but it's a good chunk of time for sure. Like, it's definitely not sitting for days on end just doing nothing. It gives you confidence to always be in the loop on stuff and always be in the know of things. And haven't had a big story come up and it happened actually 2 days ago, but you're only just now hearing about it.
I haven't said this week, so I just think it's a good time to say this. If you're kind of hearing our answers, Paul, and thinking, bloody hell, like that's like hours and hours more than me, don't let that put you off, because you can be an investor by putting in 100 quid into a global index fund every 4 weeks, every month. So you don't have to do that. A lot of what Jay, Jordan, and myself do, some of it comes from like a hobby or like an interest or being very active in the Discord. I wouldn't say that everything I do is hyper relevant to the stocks and the funds I own. A lot of that is so I can talk on here, or so I can contribute, or so I can be a helpful person in the Discord. So like doing investor, it really is a range. It like it's a I like it I like it's a pure spectrum. Like you can basically know nothing, look at nothing, have your pie on self-invest, auto-invest, whatever it's called, just once a month. So don't be put off if we do a lot more than you, but you can do that if you want, but it's not necessary to. Like it depends what you're doing.
Yeah, so one more question and we'll finish it on this question, because I think this one's probably what a lot of people do now. So it'd be interesting for 3 different answers, because I think we will have different answers. So we'll be honest as we can. Do you guys monitor your investments daily? I'm assuming probably means looking at your portfolio, doing whatever. We'll all be honest. We'll all do what we do. My missus will be looking at this and shaking her head right now when she's watching this. I do. I definitely do. So I wake up in the morning, I check it. Probably check it about 20 times at work, but not because I'm bothered. Like not because emotionally I'm like looking at it and I'm bothered what's happening. She made a comment before, which was funny and true, that I'll rotate between 3 apps of checking something. It'll be, there was 3 certain apps I'll check, have a look, put my phone down, 15 minutes later, pick it. I don't even realize I was doing it. And she made a comment about it, so I can't really get out of that. But I'm not in regards to, I think it's just force of habit. Everyone has different mindsets, but I've seen it drop, rise. I'd never look at it and start pacing around here. I was worried that my life's over. I do check it more than I probably should. That's helpfully enough. What do you do, Will?
Yeah, so I'd say I probably not daily, but probably 3 to 4 times a week. But it definitely increases in times like this, because when I am checking, I'm not checking in terms of like worry or panic. I'm more checking because I want to buy more. So I'm looking for buying opportunities. But that's why I've got more recently gone to the like the push notifications on certain things. So I'm not checking as much. And definitely one thing I've noticed is my main, like if there was a feeling, the main feeling I have during times like this is, fuck's sake, like why don't I have more money to buy more stocks? It's not, oh my god, like my
Because cash is not trash.
It's not because my portfolio is going down, the stocks are going down, I'm worrying and panicking. It's more like, oh shit, like we're under the 200-day moving average, like I want to buy, you know what I mean? But I haven't always got cash on the hand. So I think it increases at the moment, but probably on average it's 3 to 4 times a week, I would say.
For me, I mean, pension side once every 6 months, just when I do the transfer from workplace pension to personal one. Trading 212 or ISA probably once a week. Lifetime ISA maybe once every few months or so. Like I'm quite on the opposite end of the scale. And don't get me wrong, when I started, I remember the first week that I created an ISA, stocks and shares ISA, and put mine into something, I was probably refreshing every 15 minutes for the entire week. And then it kind of faded off as time went on. I mean, like the stocks I'm in, I'll be looking at charts multiple times a day, especially if they're moving, looking for buy opportunities, for instance. But actually logging into my ISA, like looking at the portfolio account or the individual holding values and stuff like that, usually only about once a week. I've got notifications turned on if there's big moves and big things I need to, that warrant an action in some way. And similarly, not trying to always plug, but being in the Discord as well, if something big happens, I'm made aware of it as well through the Discord. So again, anytime there's something that happens that definitely needs an action, I know about it without needing to log in, and everything else is kind of just going as it is. Funds and stuff I don't need to be looking at because I've just got a usual setup and they do their own thing. Same with the pension, it's in an all world fund, it does its own thing, I don't need to check it. And the ISA stuff is again the same thing. I go in when I need to buy or sell something, and look at that stuff is in the charts, which, as I say, can be daily, but the actual investment portfolio once a week max.
I think you make a really important but slight subtle distinction there, Jordan, and I'm quite similar. I think it's definitely helpful, and I think it's fairly healthy that we are looking, but I think it's better and more healthy to be looking on TradingView, because you're getting like the dollar share price, you're looking at the moving averages, like the TA, and you're looking at the charts, as opposed to on Train 212 or Hargreaves Landon or whatever. You're seeing like your actual money move up and down constantly, and by just looking on TradingView, you're just removing your money effectively. Like it's just looking at like the pure share price. So yeah, like I am now on TradingView far more than I'm on Trading 212. I think it's such a blessing to spend 1 to 2 hours setting up your charts and just knowing that even if it's simple, just having like a basic chart set up on TradingView and then just monitoring things from there. Like it's such a good tool and it's free. Obviously, like none of us are sponsored, like it's no plug. Well, sorry, it's like it's a plug, but not, like not for our gain. It's such a good way to monitor things, to do basic TA, but not have that constant pounds ISA reminder of up and down, up and down. Are you on mute, Jay?
It does tell me at the top of the screen I'm on mute, by the way. I've done that about 4 times tonight. So the difference I'm going to take from that, because you've made a very good point now, Will, I think if you are more of an emotional investor that is checking your portfolio a lot because of emotions, not just because you're got bad habits. I think if you're more emotional, I think you are totally right. In terms like this, it might even be a better case to remove the apps where you can see the actual money flow, because all of us should be investing for a long time, not for, well, it depends on how your investing strategy is, but if you're an investor for a long time, what's happening this week shouldn't necessarily matter to you for the long run, but it will matter to you on a day-to-day when you're seeing the money going up and down. So I think if you're an emotional investor and you're checking that and these 50% drops or 10%, 20, 30, whatever it is in the stock that you hold is going to affect you, maybe a good idea is to remove those apps, because obviously you're in it for the long term, and use TradingView like you say. I do agree with that. I think that's a better way of, because you're not actually seeing the cash percentage change.
Yeah.
You're just seeing the charts. And I think mentally that would be a big given. So that's actually some good advice, to be honest.
Yeah, man. I think TradingView is a blessing. So hopefully in the next 3-4 weeks at some point we can do like a bit of like a TradingView session as well. So just bring everyone up, just bring everyone to like a basic chart level on TradingView as well.
Yeah, I think we've got a few people lined up for that, and we that are going to jump on and share some stuff. That's great. So obviously that was One Big Stock Market Sundays with me, Will, and Jordan. So thank you very much, lads. It's been a good one. It's been a bit longer than usual, but yeah, it's been a blessing. So thank you everyone for joining.
Yeah, thanks guys. I'll see you next Sunday.
Cheers everyone.